Hi everyone, a very good morning. Thank you for taking the time to join us today. I am Disha Khemani, Company Secretary and Compliance Officer of Apollo Finvest India Limited. I welcome you all to the Quarter 1 Financial Year 2026 earnings call of Apollo. We have Mr. Nikhil Anani, the Managing Director and CEO, and Ms. Diksha Nanya, the CFO of Apollo, to brief you about the previous quarter results. In case you have any questions or insights for us during the meeting, please drop your questions in the Q&A section. Hi Diksha, may I please request you to take this forward?
Yes, thank you, Disha. Yes, good morning, everyone. Welcome to the earnings call. Just give me a minute. We'll just share our screen. Nikhil, if you could just do so, please.
Yeah, just a second.
Okay, perfect. So we'll just start with the first slide. So I'll just, pause for a minute, just let you guys see the numbers. We've tried to, honestly, in this highly volatile industry that we are in, uh, this quarter has been as consistent as it could be, where our revenue has been close to around 7 crores and we've been able to generate a PAT of close to 3 crores before tax. If there are any questions regarding this, happy to take it on later. Maybe we'll move on to the next slide then. All right. So here we'll talk about the enhanced due diligence. Now, this is something new that we've been working on this quarter. Of course, earlier we've spoken about how term loans are the fastest way for us to get started from a partnership standpoint. And we've also taken you through the entire due diligence that we look at while evaluating all the NBFCs that we work with in the digital space. Before we used to deep dive into their financials, the portfolio quality, of course, we yet do that, their management pedigree, and, comparing their numbers with the rest of the industry, etc. But this quarter, we've gone an extra mile, like quite literally, and started visiting these companies so that we get a better flavor of how these companies function. Our team has visited around 4 to 5 cities in the past quarter, and we've spent an entire day with each company just to get a pulse of the company, to get a feel of what is their DNA truly like. We've started to meet a lot of their members rather than just the key management that we used to get to meet earlier, while visiting each other's offices or on virtual calls. But sitting on the ground, understanding what they're exactly doing, how they function, the culture, the vibe, all of these things has given us a very deep understanding of the company who we are, are wanting to partner with. A key dimension that was missing earlier in the due diligence process was understanding the DNA, which of course I'm sure you know Excel sheets and documents cannot ever clarify. And this is what we found, that basically not all digital lending companies are tech first. And of course, there's no right or wrong. But it's important to understand their approach because this helps us in identifying them better and evaluating them better in terms of what are the risks associated with partnering with these companies. Of course, some companies we realized are very dependent and very underwriting heavy in terms of the kind of data science teams that they have built around, the kind of ML models they use. A lot have already started using AI to their advantage as well. And they have a much leaner collections team. So then you know that this company that you're evaluating is more underwriting heavy and less collections heavy. And of course, they probably don't need a very collections heavy team because their underwriting is that deep and strong. So this gives us an understanding of how to partner with them in the future. Also, there are some companies which are very collection focused. There are those who have 300 member plus in-house collections teams. And of course, like I said, there's no right or wrong, but it helps us understand what their moat is when we visit them in person. And another key aspect, which any partnerships business involves, any B2B business involves, is relationship building, which is something that gets deeper because see, finally, our partners are our extended team members. And it's important because it's full of friction. It can be full of friction. You're working with them on a daily basis. So our team visiting them, sitting with their team members who they will eventually be interacting with on a daily basis also helps our team get in sync with them, not just from a due diligence perspective, but also making sure that the relationship moving forward remains smooth, frictionless as possible, because we've been doing this for 8 years and we understand the value of partnerships being less transactional and more relationship based also. So yes, this is a key thing that we've done this quarter. And it's not only helped us identify the partners, help us work with them better, but it's also helped Apollo in terms of knowing what its key strength is. Having sat with them for like a good 24 hours and worked very closely with them, we at Apollo have realized that our key strength truly is technology, which we were very happy to have double checked on while we visited these companies. And yes, this is the update from a due diligence standpoint. What I'll do is I'll ask Nikhil, to take this forward. He'll tell you a little more about what else has been growing in Apollo internally.
Perfect.
Do you want to take it forward? Yeah.
All right. Thank you so much, Diksha. Let me just, carry on this ahead. So, one of the things that we had touched on last time, right, is the fact that we really wanted to deepen our distribution, and we didn't want to work with, just the run of the mill or, guys who are just starting out, right? We wanted to kind of work with people who've proven themselves to a large degree. And, as you can see, I think over the last couple of quarters, we've made tremendous progress. Pretty much, I would say, I think we've ended up working with, at least the top tier, fintechs in the ecosystem. If not all of them, the majority of them, as you can see, we've basically laid them out as well, right? I think one of the biggest questions we had last time is, who are the companies that we are looking to work with? But I think given the work that we've done over the last, few quarters, now we're happy to kind of share this list as well. You can see the list is quite varied. There are companies which are, targeting right from, your salaried employees to your blue collar workers, some in, tier 3, tier 4 cities, some targeting only kind of, women borrowers as well. So the goal has been, to have a pretty diverse set, but all kind of focused towards, the unsecured retail space or the unsecured MSME space, right? So the spectrum is quite wide. And across all of them, basically our focus has been to establish, some kind of partnership or the other, right? Maybe it's a, BC partnership, whether it is a co-lending partnership or finally, whether it is a term loan partnership, right? It's been either of the three that we'd like to establish with them, because what we kind of found out is, one can lead to another. As we kind of mentioned in the previous quarter as well, and Diksha kind of talked about it as well. Our focus has always been to try and first establish with NBFCs a term loan relationship where we get to understand, the numbers of their company a lot better. And once we're able to do that and, establish a deep relationship with them by even visiting their offices and having comfort between the two teams, that usually expands in a BC or a co-lending partnership. But sometimes opposite scenarios have also happened where we've ended up doing a BC or a co-lending partnership with them, and we've liked the experience and the quality of their book, and that's also, led to potentially a term loan. Now, talking little bit about where we see the company going, across the next few quarters, right? Our goal is, as we had mentioned even in the last quarter, right? It is to establish at least a 70-80% retail book and maybe a 20 to 30% wholesale book. So that trajectory seems to be on track for us. And we are happy to see that the trajectory that we had planned for is pretty much holding true. With this, I want to talk a little bit about what are some interesting things that we've been working on, and especially to do with what we believe is the future of term loans, right? So let me talk a little bit about something that we hinted at in the last quarter as well, but now finally it is live, and we call this a warehouse term loan. So this is the simplest way in which I would kind of describe this is, imagine if a term loan and imagine if term loan and co-lending had a baby, right? That's what a warehousing term loan is. And all of this is possible because of a tremendous use of technology, basically. So let me explain to you in simple words what something like this is, right? Typically in a term loan, right, money is just transferred to the NBFC's bank account, and obviously there are legal agreements in place which control what this money is used for, what are kind of borrowers that the person can basically lend to using that capital, right? But a warehousing term loan is a much more deeper integration into the other NBFC, where there is a lot more control from a cash flow perspective and from a policy perspective of what the opposite person is actually doing with the money. So let me explain this in very simple words, right? What typically happens here is that, let's say an example, Apollo decides to give a term loan to another NBFC of 10 crores, right? What would happen is there would be two accounts which would be created. One would be a bank account, which is a disbursement account, and second would be a collections bank account. Apollo would transfer its 10 crores into the disbursement bank account, and the partner NBFC would put in their version of the collateral, which is usually in the range of 20 to 30%, right? And they would basically put in their 2 crores as an example into the disbursement account as well. From this, then Apollo would have complete control thanks to Sonic basically ensuring only the customers and the borrowers which have been approved by Apollo's bureau engine, essentially, right? And which is largely done by Sonic. Those are the customers which are approved, and only those are the customers which end up getting loans from this capital, right? Uh, as and when the customers make the payments, all of those payments come into a collections bank account, and that essentially ensures that Apollo has complete visibility and control over the cash flow in this ecosystem. And also at the same point in time, Sonic has completely integrated into the collections bank account so that it's recording a real time, not only the payments but also the quality of the portfolio, right? And in this way, what Apollo does is ensures that the money that we're giving the opposite, NBFC is used to do lending to the right set of borrowers and also maintain live control over the quality of the portfolio and as well as control over the cash flows, right? So this is, in our opinion, the future of term loans. We strongly believe that this is again a clear demonstration of something which I feel only Apollo can do. And the reason for that is, this is again a perfect marriage of, lending combined with, tech. And when you do something like this, you are able to build really, really robust structures, which can allow, relationships to scale tremendously. This obviously benefits us because we get a lot of data, underlying data, and a lot of transparent underlying data about the performance of the portfolio. And if we see that something like this is really successful, it allows us to transfer a relationship like this into a co-lending or a BC relationship that much more confidently. Finally, I'd like to highlight one of the things that we are always constantly working on, right, which is hiring. And we wanted to highlight this because the approach that we're taking now to hiring is slightly different to what we were taking so far. Um, our goal right now is to end up hiring a team with specifically a lot of experience in digital lending. We feel like the time for that has come, and largely that's due to the maturity in the ecosystem that we see. The advantage right now that we are observing is that the industry is about now 8-9 years old, and there are people who have demonstrated high level of performance and understanding of the ecosystem. So we feel now is a great time for us to basically hire people with this specific skill set, and who have been nurtured by the industry, and it's a good time for us to get them on board to help us go to where we are going that much more faster, right? So with that, I'd like to pause, and if there are any questions, would love to kind of take them from here. Thank you so much.
Thank you, Nikhil. We will now open the floor for questions. If you have a question, I would request you to please raise your hand so that I can make you the speaker, and then you can unmute yourself and share it with us. Ready? Okay, so we have one person. Lawyers, can you please unmute yourself and you can go ahead by asking your question?
Hello, can you hear me?
Yeah, go ahead.
Yeah, my first question is why wasn't the AUM recorded on the presentation? And secondly, for the co-lending warehouse deal that Nikhil talked about, why are we contributing most of the capital? Can't we have a system where we use the leverage of our partner, bank to actually take in more of the capital? So we get more leverage. That's my second question. Thank you.
Sure. So let me give some insights on top of that, right? So one is, I think, we will be sharing the details of our AUM. I think, in the next month, I believe there is going to be an AGM. So we will be sharing that along with, the details of the balance sheet as well. I think, secondly, to answer your question in terms of, in the warehousing structure, right? Why are we contributing most of the capital? So typically, this is, the way we think about this is an iteration or a future iteration of a term loan. So typically, the industry standard for a term loan is that, usually when you contribute, when you give a loan of say 100 rupees or so, the opposite person gives you security worth 120% or so. So that's exactly what we are replicating over here, right? So as an example, if we contribute say 10 crores towards a term loan, the opposite person adds another, say 2 to 3 crores into that pool, and the security that Apollo ends up getting is the entire pool. So, a 120 or a 130% of the capital that we have put in. So, it's in line with industry, basically, what we are basically doing at this point in time. It's I think maybe you're getting confused with co-lending with another bank. So Apollo does not do co-lending with another bank at this point in time.
Thank you.
Thank you, Nikhil. So our next question is from Mr. Puneet Gupta. Mr. Puneet, can you please go ahead and unmute yourself and ask your question? Mr. Puneet, you are not audible. Okay, it seems Mr. Puneet.
Hello,
Yeah,
can you?
yeah,
Yeah,
Mr. Puneet, go ahead.
yeah. I see other income of 2 crore rupees in the financial statement. So I need to know what's that other income.
Sure. Uh, so that's actually, I'm sure you are aware, we've moved offices last year. The previous office that Apollo was in was owned by Apollo itself. So there's actually been a sale of property. That office we have sold, considering, of course, we don't need to be in the real estate business. We'd rather deploy this money towards lending. And that's the other item that you're noticing in the P&L.
All right. Thank you. So as I see in our that revenue has decreased. What's the reason for that?
Sure. So, basically, I'm sure we've told you, we've given this explanation in the past also. Our industry is quite volatile, right? Newer guidelines keep coming up. And not only that, the whole drive for profitability when it comes to all the companies who we are working with and their lack of ability to get there has made the entire ecosystem a little volatile in that sense. And at Apollo C, of course, the stance has always been safety first in terms of growth. Like we mentioned earlier, we don't want to be a company that grows overnight and then, leaves everything to luck to move forward. We felt we're in a better situation right now where we'd rather deploy the funds in a way which we feel are more stable. We want the money to come back. We're also seeing, unfortunately, in the entire ecosystem, there are quite a few NBFCs that have been going bust as well. And keeping all of this scenario into consideration, we purposely decided to slow our growth in certain aspects when it comes to NBFCs, especially from a direct lending standpoint. And hence this has affected our P&L, of course. But well, the hope is, as Nikhil mentioned in one of the slides that he was talking about, the hope is that now that things will move forward for the better, and we'll be changing this in the coming quarters.
I want to know whether we do microfinance loans also.
No, we do not do microfinance loans.
Okay. We do only unsecured personal loans.
Yes. So yes, these are retail loans that we do. Microfinance loans are also retail loans, even they could be unsecured loans. But the difference is the income bracket of the borrower. So the way RBI has defined microfinance lending is basically giving a loan to a family member where the entire family's joint income is less than 3 lakhs per annum. So we usually don't cater to that audience from a lending standpoint. It requires completely different underwriting methodologies, and as of today, Apollo is not looking at that as well.
Thank you. That's all.
Yes, thank you, Mr. Puneet.
Thank you, Mr. Puneet. So our next question is from Mr. Sandeep. Mr. Sandeep, please go ahead and ask your question.
So my question is, right now the RBI come up with the co-lending directions. So just wanted to know, how do you see partnership and lending model evolving going forward?
Sure. I think, we look at it as a positive sign, really, right? Like, because I think already, as you kind of mentioned in a previous earnings calls, right, that we had obviously already started, doing partnerships in the co-lending space. I think, RBI has basically come in and trying to give more clarity over there, right? And at least our initial glance on what we've seen from a guideline perspective, I think it is good because it brings in a lot of clarity in terms of, how the commission has to be shared basically, or how the structure exactly should go, which basically, clears out any ambiguity and makes partnerships that much more easier. And finally, in the end of the day, there was ambiguity whether, NBFCs can even do these partnerships with other NBFCs, etc. But obviously the ecosystem, really has grown in terms of, co-lending partnerships between NBFCs, and it's good to see basically RBI acknowledge that, and not only acknowledge that, but come up with, a clear goal that we're going to come up with a clear set of guidelines, which will lead to, this kind of partnership kind of prospering. So, we see this as a supportive action, and we see this as an action where RBI is trying to bring clarity on how can, two regulated entities do co-lending together.
Got it. Thanks.
So our next question is from Miss Ananya. Miss Ananya, can you please unmute yourself and ask your question?
Yes, hi. So I just wanted to ask, is warehousing loan a tested model in the sense that has it been implemented in the Indian digital lending landscape before? And also, in case the book quality deteriorates, how do you mitigate your exposure?
Sure. So actually, warehousing is a pretty interesting structure. It's actually done in, I would say in countries like the US and Europe more. I think it's not been replicated in India largely because, as you observe from our slide, it requires a lot of tech involvement, from both sides. Usually, at least in the fintech ecosystem, historically, what's ended up happening is that I think maybe fintechs were open to these kind of integrations. I think the problem has always been the lender, being unable to, do this deep level of integration into the systems of the opposite, of the borrower in this case, which is the NBFC. So I think now with obviously Apollo, kind of paving the way, our expectation is that potentially, maybe over the next 2-3 years, depending on, how much we're able to scale this, we feel like the rest of the industry will also be very interested in replicating structures like this. Because, to answer your second question in terms of, how does this kind of help with the risk, right? So just to give you an example, right, what typically our structures look like is, they are very dynamic structures. And what I mean by that is potentially, initially we may start with maybe collateral of say, worth 20%. To give you an example, maybe against a 10 crore loan, the opposite person has to put in, at least 2 crores of their own capital, and we hypothecate potentially 120% of the money that we've given. But in case, that portfolio doesn't perform as per our expectations, maybe due to, poor level of collections or whatever scenario, right? Essentially, we do have clauses in our agreement which enforce the opposite person to add in more capital as well, right? So 20% can potentially become 25 or 30% if their portfolio doesn't, perform as per the expectations that, Apollo has laid out in the legal agreements. And finally, as well, in the case where for whatever reason we realized, the NBFC itself is, maybe not doing too well, right? Apollo can simply start withdrawing its money from the collection, account that we opened up, because all of the money coming from, the retail borrowers who've been funded by this facility, they all have, repayments which are linked to this particular bank account. So as and when the money comes back from the borrower, all of it is just withdrawn and taken by Apollo, right? So this obviously protects in two ways: one from general portfolio deterioration, and obviously secondly, and more robustly in the case of, the NBFC having, liquidity issues, right? So it's a pretty robust structure in that way.
Got it. Thanks, Nikhil.
Okay, so we have one question in our Q&A section. It says, is long-term secular growth of say 20% year-on-year income possible? How do you estimate visibility of business?
I think I would say aspirationally that's very much possible, and that's what we want to do. But we always refrain from giving any future guidance in terms of revenue, etc., right? Because our focus is more on the how than the destination. To use an old adage, right? Like the journey is more important than the destination, right? For us, I think over the last 8 years we've learned quite a lot about this industry, and we've hinted in the past as well, like, we feel like now is a very good time for Apollo to make, I would say, bolder steps and, more dramatic, changes and steps towards, getting to where we want to go a little bit faster than how we were doing it in the past. So I'm expecting the same trajectory to kind of happen over the next upcoming quarters. And, this is also the 40th year of Apollo. So we hope, we can do some things over here which are quite memorable and also make the year that much more interesting. And probably we'll have, some interesting things to share in the coming quarters, on that front as well. But for now, we're waiting for, the proof in the pudding to talk about those things as well.
Okay, so our next question is from Mr. Mahavir. Mr. Mahavir, can you please unmute yourself and go ahead?
Yeah, hi Mikhail, hi Diksha. I hope you guys are doing good.
All good, Mahavir. Thank you.
Yeah. Okay. This one question is from a short-term perspective. Like if you were to strip out this quarter's one-off income that is around 2 crore, Apollo's annualized profits would be around closer to say 4 crore. And last year we did around 9 crores. So with partner additions capped and our expenses structurally are going up also because we are expanding in terms of B2C lending partnerships and other things. So how exactly are we going to bridge this profitability gap going forward?
Sure. I mean, just to give you some perspective, right? Like I would take this, the changes that we are doing, just to give you some perspective, right? It is all in line with our expectation, which is that, we are moving. So just to give you a little bit of a long-term lens, right? Basically, as we kind of hinted in the last couple of quarters, we moved from a very retail heavy focus towards a, more defensive position, I would say, which is having more, kind of term loans going on essentially, right? I think now we are switching back to retail because we feel a lot of the volatility in the space which was there, largely from an RBI pricing perspective, that's kind of gone away. And, that is reflective also in a lot of, fintechs that we work with who have, lowered their prices as well for the retail customers. And we feel like that space is a little bit much more solid, than where it was before. Given this, I think we are in the middle of a transition period. And this is what, I would say this quarter has been all about, which is, making that transition. And, our goal is, very, very clear that once we make this transition, right, our hope is going to be more towards, scaling the retail book. That's something which we have experienced for over the last 7, 8 years. That's an area which we are very, very comfortable with, right? So I think hopefully over, this year and the coming, next year, I think I would expect a lot more growth coming from retail, and hopefully all of that would translate into, our numbers as well. But I would potentially say that last year is very different to this year, because this year, if you just, Google basically a little bit about, RBI and digital lending, right? They've been, very, very active, this year, particularly when it comes to, pausing even very, very large NBFCs such as, Navi or a DMI, right? Which has obviously huge, impact on, I think, not only them, but the rest of the ecosystem. So that is something which, we've had to absorb this year. So, our hope is with all the changes which have happened in the ecosystem, I think, for the rest of the year and the coming next year, I think we should see, positive reverberations from that.
Okay, great. Okay, this one is more from a long-term perspective, we have in the past we have talked about Sonic and now Senti and other things. What are the modes that we are building very silently, inside, which will look very obvious, especially to stock markets, because given we are at a 3-year lows or something like that, and I understand that that is now beyond our control. But what are the things that are going to look very obvious in hindsight to the stock markets that are not visible right now?
I mean, to answer this question, I would just say that Apollo's focus, right? And elaborate on that, right? To me, the way I think about, the strength of Apollo is that, if there's one thing that we know is digital lending, and it's not about like knowing it from a, qualitative perspective. I think we quantitatively know digital lending because we frankly we have data over the last 8 years doing just this, right? So I think, there will be a point, historically looking back, at this company where, people will, think that this was so obvious, that a company was building in a space which is basically, in my opinion, like digital lending is nothing but a math problem, right? Basically,
Yeah.
it is ultimately all the lending which is done over here. If you have enough data, it's ultimately a math problem, right? Like, you have to basically build a model which predicts defaults essentially, right? And you have to, for the riskier segments, you have to price it accordingly. So to me, ultimately, like, if I was to look 10 years into the future, I would probably think that, this would be very, very obvious, looking at a company like this, because if you ask me, like, that is a big issue, I think, or big mistake, which a lot of, other lenders are pretty much doing, which is, trying to go too fast, and then you end up crashing the car, and then, there is no more car to basically drive, right?
Yeah.
I think for us, what we've been doing very silently is that over a period of time, we have a lot of data, we have a wide variety of data, and this, has really helped us basically in doing smarter and better underwriting, better pricing, everything across the board. And that's, already beginning to reflect when you look at our NPA numbers, right? Especially over the last few quarters. So if I was to just project this, 5 years or 10 years down the line, I think all the actions that we will take, from now onwards will keep reflecting this one strength of ours, where, we just know how to do this stuff. And it's not even about, building, I would say, company DNA. It's about, building the data to do this.
Okay. And one more thing is do you think capital is a hindrance for us? Because, if I were to actually break it down to the two major components, one would be we are lending, and that is the interest income that we are earning. And the other would be obviously Sonic, I guess. So how we are doing on the front that is Sonic right now? Of course, we are in a building phase right now, but are we seeing any positive signs from our partners and, yeah.
So Sonic is basically the backbone of the company, right? In simple word, that is like, I mean, that is the differentiator of, Apollo to anything else, right? Because variety of factors, right? I mean, number one, it allows us to integrate with any other, lender, whether it is a fintech or NBFC, in couple of weeks, where rest of the industry yet continues to take 6 months, right? There are jokes in the industry where, integrating with somebody is equivalent to a pregnancy, right? Where by the time your integration is done, a child is born somewhere, right from start to finish, right? It's that slow and that painful. for us, like that's something which is obviously not, true at all, right? In a couple of weeks, we're able to, integrate with somebody, and, we're in a space in any startup or any tech ecosystem, time is money. So that's point number one. I think point number two from a Sonic perspective is it helps, in internal operations as well, right? A lot of the reports which other people are ending up doing manually, we've continued to build a lot of it, automations which have made the jobs of our own team much, easier. Obviously, a more public example of that is something like, Senti, right? Where if we're doing a lot of partnership business, the biggest problem is that a lot of these guys end up having so many call centers doing calls to borrowers. And how do you monitor all of these calls and make sure that everything is, compliant and we're speaking, professionally with borrowers, right? Because this is a huge problem, not only I would say in digital lending, but in lending altogether, right? If you just Google bad collection practices, you will come up with 1,000 articles, even from people like, a Bajaj or an ICICI or whoever, all doing malpractices when it comes to, doing collections, which I personally like to believe that it's not something that they want to do, but it's a rogue collection agent, taking, steps on their own just to earn more commission or, bonus basically, right? By scaring the borrower, right? But obviously that's not compliant. Now, if you think about scale, you can't do this, without basically, high level of automation, and that's where AI has come in, right? I think AI is going to change the game completely, especially to do collections. Now, I think one part which we've already publicly spoken about is doing collection, monitoring collections using AI, right? But I think the next phase of digital lending is going to be collections itself happening through AI, through voice bots, and that's something which, we've seen enough demos inside the company to truly believe that, when these demo calls are happening and, collections are happening through voice bots, basically, right? Uh, it's pretty much indifferentiable from a human being talking to you, right? I think we are reaching that phase already. I think there are already, enough beta tests going on for me to pretty confidently say that there are, clear instances of a bot calling up a borrower to do collections and the opposite person not realizing that he's actually talking to a bot. So a lot of those things are basically already at play, right? And ultimately, I think the more and more, I see all of these things, it makes me feel like every industry is ultimately a tech company or a tech industry, where domain expertise is very important. But I think that tech DNA of Apollo Finvest, right, is what, really helps us differentiate and do things, which other people, can't do as efficiently or can't do as fast. It'll always be very apparent, and we feel that every single day.
Yeah. And I've been like tracking Apollo for last 2 3 years, and we have like Sonic has always been a point in the conversation. So this is a question on Sonic. Are we just a 2x enabler for compliance and things for our partners, or are we actually going to help them in 10x ways? That is one thing. And how sticky Sonic really is, as in what would be our oldest partnership, as of today? Do we have any partners that have stuck on with us for last 5 7 10 years? I don't know. Yeah.
I think unfortunately, like most partnerships, I mean, the oldest partnership we'll probably have right now is like maybe 2.5 3 years. And this is, more a reflection of the space, than it is to us, right? I mean, very honestly, if you just, try to look at any company from a fintech perspective, which have been there for the last, maybe 7 8 9 years, I think that list is incredibly small, right? And we've had very public examples of, companies like Zest Money or a lending card, basically, who were at some point in time, I would say the poster boys of the industry, but, are completely absent today, right? So I think, this space, I personally feel now, uh, I think that will change significantly, right? And we said that in the last quarter as well. I feel now we are seeing a lot more industry, a lot more companies actually being profitable. If you would have asked me this question like 2 years ago, I would have said, maybe less than 5% of the industry is profitable. Today, I would say more than 60 70% of the industry today is potentially profitable, right? So I think the industry is widely changing, and that is very helpful, because from an Apollo standpoint, that leads to more stable partners. And also at the same point in time, the incentives are very much aligned of us and our partner, where in the past they really wanted to scale up and, at the cost of, a poor quality book. But now I think they are as worried about unit economics as, we are, to make sure that not only are our partners profitable, but obviously at the, back end, we are also profitable, which ends up creating a more stable partnership, because nobody ends up wanting to break up a relationship where you're getting capital and, really great technology, as long as you yourself are making money as well.
Okay, that's it from my side. Thank you so much, Mikhail.
Thank you.
Yeah.
Thank you, Mikhail. All right, it's look like we have covered all the questions as of now. If you have any further questions, please drop us an email. Our team would be more than happy to get back to you. Thank you all for joining our today's call and the continued support to Apollo's journey. Have a great day.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.